Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Thanksgiving holiday starts in the Western markets, and as traders go for a holiday, things would rather be on the quieter side. When it comes to inflation, US consumer expectation of inflation shows the consumers are expecting the inflation to persist. Moreover, applications for US jobless claims fell last week after a series of increasing data points. Good morning, JK. What's your interpretation of the data, and how do you think the dollar will be placed?
Yes, yeah, jobless claims fell 24,000. That's quite a big number. But what you need to bear in mind is that the jobless claims data tend to be especially choppy towards the end of the year and around the holidays. A typical retention of workers ahead of Thanksgiving holiday explains also the drop in the seasonally adjusted jobless claims. So we do not read too much, and even the market did not read too much into it, apart from initial reaction of dollar recovery and the yields going up. The Michigan report also was better than expected compared to the initial estimates, and the inflation expectations have been once again 0.1% higher. That's mainly because the services inflation is not coming down, while we have the goods inflation dropping, particularly on the crude and the resultant gasoline prices in the US dropping also. But yes, consumer sentiment is driven by the services inflation, which is not dropping as much. We also had somewhat of a underwhelming data in durable goods orders that fell 5.4%. That is a very big drop compared to the previous month, and the expectation was at 4%. If you look at the picture of a US economy, we are seeing a sense of economy slowing and slowly turning to the downside, but it's really not falling off a cliff. So that's the picture that we're getting. Yesterday we did have some interesting news. On the mortgage rates, they have continued to slide. The 30-year fixed loan was at 7.29% from 7.44% last week. It had hit a historical high of 8%, but this still is quite high on a historical basis. Only a further drop in this can support housing market recovery. We had some news from the other side of the Atlantic also. The CBI industrial trend orders in the UK fell to -35, down from -26 in the previous month, and this is the lowest since January 2021, well below the average of -13. Even the British Finance Minister, Mr. Hunt, announced quite a bit of tax cuts in his autumn statement, and this has been facilitated by higher inflation increasing tax revenue. But the tax cuts have underscored the pressure faced by the politicians. We are aiming to win back the voters and claw back the 20-point gap that the Labour has suffered recently. The consumer confidence in Euro area also picked up unexpectedly in November, reversing course of the previous month's decline as price rises decelerated. This increase is come about because of the inflation easing, as well as the energy prices, which are quite low compared to the what we had seen in the last several months. Now, bonds saw bigger volatility during the day. Profit takers on recent longs and fresh buyers were in play. Initial drop to new cycle was followed by a rise in the yields after the data, but once again they have come to the middle of the range. So we are somewhere in the equilibrium level for the time being, waiting for more clues on the economy and inflation. And with the Thanksgiving holiday followed by a long weekend, I think we will not see much of a volatility today. Stocks showed little reaction to the inflation disappointing number on the Michigan, as well as on the jobless claims. They were on the positive territory, and generally it's been observed that just ahead of Thanksgiving holiday, markets do have a rally. But contrary to expectation, the NVDA stock, which reported revenue well above the Wall Street expectations, fell, but that was more due to a profit taking that which is normal actually. Now, what is supporting overall the market is also a spate of economic data, which is not really, again, repeat the same thing. It's not falling off the cliff. Economy is still holding up. At the same time, inflation is coming down. Rate cut expectations have increased to 100 basis points for the next year, starting as early as May. So these are supporting. But what will be crucial for the stocks to hold on will be the liquidity that's that is steadily eroding as we face the huge supplies from the Treasury's new paper, and also the QT that is ongoing. Incidentally, European stocks hit a 2-month high with the volatility, the equivalent of VAX in the US, they're dropping to lowest level since July. And of course, the improving consumer sentiment also supported. The move up in the yields triggered the dollar also to recover against the main currencies, that is the GBP and Euro. Even the yen went up to 149.58. But then all these things, I would call them as a correction to the recent big fall in the dollar against these currencies, and therefore not much to read into it, not expecting too much moves. Of course, we do have fresh look at the economic activities, particularly in the European and the UK region, as we see the flash PMI numbers on the manufacturing and services to be published today. So that can be one trigger, but I don't think reaction will be too much once again. On the oil tumbled as much as 5% in the earlier part of the session yesterday, as the OPEC plus group of oil producing nations postponed their scheduled meeting, so that actually pushed it even further lower, but then it has since recovered quite a bit. There is sense that Saudi Arabia is not happy with the production levels announced by other countries, and they having to cut more is not something that they are okay with. So that actually led to the fall. But then fundamentally looks like, I think above 75 is a very good support for the crude oil, considering that the Chinese economy is recovering and US economy holding up, Europe probably showing some tentative signs of stability as well. On the rupee, we did see some marginal strength to start the day with the reported IPO flows being mentioned. We have quite a few primary issues being talked of, being announced, and they are attracting some flows, no doubt. Once again, of course, the foray below 83.30 was short-lived, and we saw a jump to 83.34, 35 once again, needing the PSU banks to once again come in and supply the dollars. I think this scenario will continue for at least another 10 days, by when we will have some clues on the political developments with the state election results being announced. So it's going to be a holiday in the US. Customers cannot have a cash outward remittances, but maybe they will get cash inwards. Banks might quote the rates if it is a small amount. Yeah, thank you.
Thank you, JK. And US jobless claims were dropped, but usually, as JK mentioned, towards the end of the year, it tends to be a little bit choppy. And one interesting point also which JK mentioned was that ahead of the Thanksgiving holiday, companies would not rather lay off their employees. Now, Michigan inflation expectation was 0.1% higher. So all this data, along with whatever we have seen in the past month, is showing that the US economy has been slowing and has been on the weaker front, but of course nothing like it's falling off a cliff. So not that weak, but still on the weaker end. Now on the UK front, Jeremy Hunt, the Chancellor, announced some tax cuts. This is again some sort of pre-election stimulus. Oil took a big fall after OPEC Plus postponed their scheduled meeting, and it's rumored that Saudi Arabia is not very happy with cutting more, or with the current levels of production, and they having to cut more. And for rupee, we saw some marginal strength below 83.30, but then from there we saw some strong demand pushing it back over 83.30. Now, as JK mentioned, because of the US holiday, there won't be any cash outward remittances, but of course the inward remittances and all are properly functioning. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.